if there was true price discovery was allowed to occur in the precious metals market, precious metals, gold and silver would be a lot higher. Let's just say it would be at least magnitude of 3 to 5 times higher than where they're trading, and probably even higher than that.
The land of Arcadia.
Well, hello there, my friends, and welcome to Arcadia. Chris Marcus here with you on Wednesday, June 20th, 2018. And I'm excited about today's guest. In addition to being a brilliant financial analyst, proud to also call him a friend, lives out here in Denver as well. And especially given all the things I talk about on the channel with precious metals and the precious metals manipulation, Dave Kranzler is an expert in both of those fields. So excited to have you on here today, Dave. Are you there? And how are you doing, my friend?
I am here and doing well so far today, but I don't know, it intimidates me a little bit if you call me an expert, because that might make it sound like I know what I'm saying. I don't know if anyone knows what they're saying when it comes to precious metals.
Well, certainly it's a fascinating environment where often the underlying fundamentals don't seem to match the price. Although I was thinking perhaps just to get started, if you could give people a little bit of your background, because I think that, especially you and I have talked about that before, but a lot of your experience, I think really sets the context for some of the things we'll dig into today. So just if you could share a little bit on some of the shops you've worked at and how you ended up really focusing on precious metals and what's going on in the economy now.
Sure. So when I came out of college, I was an economics English major, and I worked as in the two-year analyst program at Goldman Sachs in fixed income. And then I wasn't ready to go to business school after my 2 years. So I ended up working for a couple of years at a small investment boutique in New York. And then I went to Chicago Business School and came out and went and became a junk bond trader at Bankers Trust. And I did that for a little over 9 years. And when Deutsche Bank acquired Bankers Trust, I pulled the ripcord, and I was ready to move back to Denver anyway. And I kind of started just getting involved, trading my own account full time. And I met someone who introduced me to the precious metals market back in 2001. I mean, in early 2001, he said, you ought to take a look at gold and silver. And I was like, and mining stocks. And I was like, that's not really my thing. I'm having too much fun shorting the internet and tech stocks.
Right.
And he finally convinced me to start looking at it, in like mid 2001. And I dove into it head first. I mean, it was like I was all consumed with learning everything I could about it, because once you start digging into it and what it represents, and the whole history of it, and you could clearly see from the charts that something was going on in the sector. It had come down from 875, silver hit 50 in 1980, and it had gone all the way down. Gold bottomed out at 250, and silver, when I got involved, silver was like basically $4. There might have even been some days when it was trading under 4, but you could see that it was, if you were a chartist, you could see that it was forming a very powerful bottom. And back then, the mining stocks, a stock like Goldcorp, trying to think, you could buy it for $2 or $3. And then there were, junior mining stocks that were trading for under 50 cents that, eventually were trading 12, 15, $20. So, and that, that's sort of how I got into it all. And it obviously, when you start looking at all of the trails that studying gold and silver and everything related to it leads you down, all of a sudden you start seeing the dark side of what's really going on in the financial system and the political system. So it was funny, because the guy who dragged me into the sector back then, I mean, every day we would talk on the phone of, 2003, 2004, be like, Eastman Kodak's going to go bankrupt. They've got a balance sheet that's going to blow up. GE has a balance sheet that's going to blow up. And we actually thought what happened in 2008 would happen in 2005 or 2006. Little did we envision that Alan Greenspan would ignite the subprime mortgage and subprime lending industry, and that's what kind of kept it alive, the whole thing alive. It ultimately made it worse also. So we knew what happened in 2008. We knew 2003, 2004. We knew something like that was eventually going to happen. We were just very early. So
which I think is a good dynamic that helps put things in perspective for people now, certainly where I think a lot of people, after things collapsed and leading up to 2011, especially following Bernanke's incredible op-ed in the Washington Times right before launching QE2, and people are saying, all right, well, we see the money printing, we see metals should go up, yet it's similar to what you mentioned, where if you were in 2004 or 2005 saying that there was a bubble building, you weren't necessarily incorrect, but it was just a little before it happened.
Yes, I mean, and a lot of people don't even realize this, but if you look at a chart of the housing stocks, and I use the Dow Jones Home Construction Index, that actually peaked in July of 2005. Mm-hmm. And it started going downhill in July of 2005. And that's probably something that would surprise a lot of people. So, I mean, the stocks were telling you that the gig was up in the housing market in mid-2005. The signs were there. It was just, people were intoxicated by how easy it was to make money flipping homes and buying stocks and day trading stocks. And so people were kind of blinded to what the reality was. And we're seeing the same thing now.
Yeah, I was just about to say, I follow your research, which people can find at Investment Dynamics Research. And it seems like you've started seeing a lot of those signs, especially in home builders and a lot of the other stocks, that it's perhaps we're nearing the top, if we haven't already seen the top of some of those bubbles now.
I think so, but who knows? I mean, I posted a blog post today, and it just had 3 charts. It was Netflix, Amazon, and then Nvidia, and it's a 5-year daily. And I mean, those stocks over a 5-year time period they've gone parabolic. It's unbelievable. And that's the problem is I mean, really the definition of a bubble is the intrinsic value of these assets or these stocks is so far disconnected. I mean, the market value of these stocks and the way the market is valuing them and the way they're trading them is so far disconnected from the underlying fundamental and intrinsic value of these stocks that, I mean, it feels like they can go up forever, but they can't. I mean, they look like they're doing a Roman candle, and it's just a question of how long is it going to take before they do an upside down U-turn and fall back to earth. I can't answer that question. No one can.
Yeah, I think that's what a lot of us are waiting for. Certainly the signs seem like it is headed there. And among the potential triggers, certainly interest rates are going up, which, from my perspective, poses the same concerns that it did a decade and a half ago, leading to the last collapse. And of course, you mentioned Deutsche Bank earlier, who was downgraded recently. And there are a lot of analysts speculating that perhaps Deutsche Bank downgrade a lot of the derivatives based on their rating, that could perhaps be a trigger to a bigger, perhaps Lehman type event. I know it's still early to tell, but any thoughts on that and anything that you're seeing there?
I don't, Deutsche Bank is like a black hole of bad positions, bad derivatives. Deutsche Bank, well, all the big banks, Goldman Sachs, JP Morgan, Morgan Stanley, those Citibank, those are the primary ones. They all would have blown up in 2008 if the central banks didn't save them. And Goldman would have been. I mean, Lehman blew up, but I mean, post Lehman and Bear, Goldman would have been the first one to blow up. That was the one that really precipitated the bailout. And And
Right.
I mean, I think it was by design that Henry Paulson was sitting in the Secretary of Treasury seat, aside from the fact that he got all the big tax benefits. But Deutsche Bank, I believe it was 2012, was going to blow up again, and the German central bank, the Bundesbank, in conjunction with the ECB, bailed it out. I mean, honestly, I think if Deutsche Bank goes, it's going to take down at least the entire Western financial system, because there's so much hidden leverage and so many bad derivatives positions. I don't even think the people inside Deutsche Bank or the regulators have an idea of just how bad it really probably is. Now, the guy who ended up running Deutsche Bank, Anshu Jain, I mean, that's one of the reasons I wanted to get out of Deutsche Bank. I mean, these were all ex-Merrill guys that were at Deutsche Bank, and they were running Deutsche Bank, and Deutsche Bank acquired Bankers Trust, and so they were in control of the whole thing. And they bought Bankers Trust for the derivatives business and the leveraged lending business. Deutsche Bank wanted to become the #1 derivatives player and the #1 leveraged lending player. And you know, Anshu Jain was hell-bent on eventually running the bank, which he did, and he eventually got canned. But that guy, I'll tell you, I mean, I shook his hand once, and I literally, when the meeting was over, I went home and took a shower. I just felt so oily. I mean, I doubt there's an ethical bone in his body. And I have no doubt that even he couldn't even tell you where all the bodies were buried in terms of the bad derivatives positions. I mean, that's the type of thing where you would have to have someone go in there, or a whole team, a whole army of accountants go in there and look at every derivative contract to see, you know, what the terms are, what the underlying is, who the counterparties are, et cetera. And I don't even know if that's possible. You know, and to give you an example of how easy it is to hide positions, when I was at Bankers Trust, we would have like, you know, a handful of bad junk bond positions in our inventory, and we could hide them from the internal regulators at the end of the year, and so that you know, they wouldn't find them, and we didn't have to mark them down because it would have affected our bonus pool. It's not hard for traders on desks to hide positions. I mean, eventually you'd get caught, but you know, we were fortunate enough that, you know, during the 90s, anytime we had the Trump Castle bonds, people probably don't even remember Trump Castle Casino, and it was a first mortgage bond, and I had them marked. I traded those bonds. I had them marked at 70 cents on the dollar, and for the size of position I was running, the closest bid around probably would have been 30 cents on the dollar. So we ended up doing it was actually a high yield derivative swap trade with Harvard Asset, and that was back when Larry Summers was in charge of Harvard Asset, right. And it got the position off our books, and the strike price on the way that we structured the whole transaction was like at 60 cents on the dollar. So presto, bingo, position hidden, and there's no mark to market on it. You know, eventually the market was strong enough that the bonds eventually were refinanced out. So, you know, they never went to zero. But if we had gone into a bad, 2 or 3 year period of a bad market, that thing would have gone bankrupt in the mid 90s. So, you know, that small change, what we were doing in the 90s, it's gotten to be extremely large scale. And the regulators look the other way now because there's just such a strong degree of regulatory capture by the banks over the governments, the central banks, and the whole regulatory process, so that the regulations that are even in place never get enforced.
Yeah, I think that's really unfortunate. That was a big part of my decision to leave Wall Street in 2012 because, you know, I grew up Pledge of Allegiance, do the honest thing. And then as I started to research into gold and silver, seeing something at the very least didn't seem right in there. And actually, I emailed some of the CFTC commissioners about 7 or 8 years ago. And Bart Chilton actually wrote back saying, you can look at the interviews I've done where he talks about how he believed it was manipulated, yet said it takes 3 out of 5 to vote, essentially saying his hands were tied. So coming back to the metals, whether it's Deutsche Bank or
Real
some
quickly,
other.
let me just say, I used to exchange emails with Bart Chilton, and he used to take a lot of abuse from the GATA crowd, and deservedly so. I honestly think that was a whole good cop, bad cop act that they were playing. And I don't think he ever had any intent of trying to reform the CFTC or force them to enforce the regulations with respect to the COMEX and what goes on at the COMEX.
Yeah, unfortunately, I agree completely. And I guess my next question was, which you just in some ways answered, that it seemed to me as if there's clear evidence of manipulation. The Deutsche Bank transcripts that they released are incredible, where it's not just that they get caught. I mean, they're bragging about smashing the price. And to me, it seems it's in the territory where it's almost like you have to be looking the other way. Do you see any way that perhaps these precious metals markets aren't being manipulated and maybe we're just imagining it? Or is it, again, kind of like you said, it's obvious enough for someone that has the type of background you have or should have at a regulatory agency that they should be seeing it? And in your opinion, again, that they are clearly looking the other way in regards to the metals?
Well, I mean, if you look at, and I haven't looked at who sits on the committee of the CFTC in a while, because I've given up on even caring about it, because it's really, I stressed out over it for many years. But the people who are the committee members, they're all either from Wall Street or from the law firms that represent Wall Street and keep them out of jail. So I mean, it's political. It's crony capitalism. Of course, they're going to look the other way, and I actually think it's orders on high. I mean, if there was true price discovery was allowed to occur in the precious metals market, precious metals, gold and silver would be a lot higher. I don't even want to hazard a guess on what level where they would be trading.
That was going to be my next question. Darn it.
No, it's not worth it. I mean, I used to do that exercise 10 years ago all the time, and it's just not worth it. Let's just say it would be at least magnitude of 3 to 5 times higher than where they're trading, and probably even higher than that, because there's just been so much fiat currency and so much credit that has been created that again, it's a situation where the paper money and paper credit system has gone parabolic, and they have to keep the prices of gold and silver suppressed, because that's how they keep the game going. If gold was allowed to price discover its true level, it would send the message to the entire world that something's really wrong. And so it essentially, for every dollar the price of gold goes up, it devalues the U.S. dollar by $1, right? It's essentially the antithesis of the U.S. dollar. So in order for the U.S. to maintain its massive Ponzi scheme and its charade and maintain some semblance of the dollar being the reserve currency, you have to keep the price of gold capped.
Yeah,
there's too much money at stake for the bankers and the politicians and everyone connected to, making money off of printing money or creating credit. I mean, we're talking about wrath of God money. So they're going to do what they can to keep a lid on the price of gold and silver. And that includes, telling committees like the CFTC, agencies like the CFTC, hey, your bonus when you go back to Wall Street or back to Debevoise Plimpton, your bonus depends on helping us keep the price of gold and silver rigged.
Yeah, and that part is unfortunate, although what I see as the positive here is that we have folks like you who have seen it from the inside and actually, I would say, are filling the roles of what these regulating agencies should be doing, which I think does a great service, because I know there's the perception on the outside and there's certain things that you only get to really grasp by having some of the experience that you have. So I'd like to recommend people to go check out Investment Research Dynamics. Dave, could you give us just a few thoughts on, I know you published the 2 journals and some of the things that you offer for people who see what's going on and are looking for the solutions, how to position their money and how they can find you?
Sure. My blog is Investment Research Dynamics at investmentresearchdynamics.com. And as you mentioned, I publish the Mining Stock Journal and the Short Sellers Journal. The Short Sellers Journal is a weekly newsletter, and the Mining Stock Journal comes out every other week. And I essentially, have a few pages of what my market commentary from my point of view and what's going on. And in the Short Sellers Journal, I take apart the economic reports of the week, and then I offer up short ideas. Right now, I'm pretty heavily focused on retail stocks and home builders. The home builders are probably shorting the home builders right now is probably one of the biggest no-brainer trades besides going long Amazon and Netflix in the market. So, and there's still a lot of money to be made there. I actually, I've been studying the home building industry since the 90s because that was one of the sectors I traded as a junk bond trader, was the home builder bonds. And all these companies originally, a lot of them, not all of them, but a lot of them, most of them that are public companies now were creatures of Drexel Burnham and the Drexel Burnham junk bond machine. So, and a lot of them went bankrupt in the early 90s and reemerged with junk bonds and then went public. So I've known a lot of these companies for quite some time. And I continued studying the housing sector and the home builder stocks after I left Wall Street. And then the Mining Stock Journal, I tend to focus on juniors. I've had a number of really 5 to 10 bagger success stories. I've had a couple of pigs, but I think the junior mining stocks right now are probably almost as cheap relative to the prices of gold and silver as they were at the end of 2015, and they're probably cheaper relative to the price of gold and silver than they were in 2001. And so I think right now is a great opportunity to get into the sector. Sentiment is really bad, and that's usually when you want to start buying these things. And then I also, I have like shorter term trading ideas. One of the ideas that Gold Standard Venture, that stock took a huge dump. I think it was about a week and a half ago, and it traded all the way down from $1.50 to $1.20 on no news. And I looked at it and I'm like, So I emailed the CEO, and literally 5 minutes later, he emailed me back. And because I said, was there anything I missed here, anything going on? And he explained what was going on. There was a newsletter writer who had done a write-up on Gold Standard Venture in January, and I guess he told his readers, I don't know who it was, I didn't ask him, told his readers to have stops in at $1.50. And if you look at the chart, I mean, it literally fell off a cliff at $1.50. So we put a bunch of it in we have a sort of a small core position in it anyway, because I like it on a fundamental basis, but added a big trading position into our fund, and I recommended it in my Mining Stock Journal last Thursday at $1.20. And you see that it closed today at $1.32. So, it's already a pretty good percentage price gain. So, I do things like that.
Yeah, well, I'm a new subscriber now, which I'm excited about. I've been reading through some of the reports. And again, I would recommend to anyone listening today that, especially if you're tired of seeing how the banks give out advice that is often better for the banks than your own accounts, I think it's really exciting that there are folks like you, Dave, who are not just coming from academic background, but have actually been there and done that, and now are trying to help people be prepared for, some of the things that are coming. And I love that you cover really both sides. If people are seeing the bubbles, looking for short ideas there, you have that covered. And similarly as well, if people want to get long metals or miners, you provide some great research. And appreciate you coming on today. I know you're looking at the markets around the clock, but I think this was great information for people to hear.
Hey, Chris, real quickly, that's right. I forgot you are a subscriber. Did you buy Gold Standard Ventures?
Not yet, but I do have a check clearing in my account for some shopping. So again, that's one of the well, there we go. That's why people should be getting the journals and checking out your site. It is good information. I found you to be one of the best minds out there that fortunately is sharing what you're seeing. So again, appreciate that coming on, Dave. And it's been great getting to know you over the past year and looking forward to some exciting times.
Likewise. Thanks for having me on your show. And let's definitely do it again.
Will do, my friend. You be well.